Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today on the podcast, we have my good friend, Bromley Palamountain. Bromley empowers people to make their financial dreams a reality through purpose, clarity, and design. He's helped a lot of my friends as their financial advisor. And it's so important to be working with a very strong financial advisor who understands your personal needs and your risk tolerance. And I'm looking forward to Bromley adding a ton of value for our listeners today. Bromley, can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, absolutely. Thanks, Gary. So, yeah, the work that my team and I do, and I'm happy to jump into some personal background as well, but we help with our clients with financial planning. So really getting clear and concise on where they're trying to go, what those timelines are. I help them understand and organize their balance sheet, think through tax considerations, and then ultimately re-engineer or reverse engineer a distribution strategy to fund their retirement. So a lot of it goes into the plan and kind of keeping that plan on track with quarterly governance meetings. But a lot of it also is specifically implementing strategies along the wealth management front, helping mitigate risk on the insurance front. So we kind of tackle a lot. A lot of time I'm in meetings with their CPAs and coordinating kind of that balance or trade-off between optimizing for today versus optimizing for the future. So it's really fun work. It's meaningful. But then end of the day, I'm just trying to help people improve outcomes in the direction of their goals as it comes to their family and personal finances.
I think you touched on a really good point because I hear a lot of people complaining about their CPA who doesn't talk about tax planning because they'll do your taxes, but they're not really thinking about that piece. And you combine working with the CPA as a team is incredibly beneficial.
100% agree because the CPA's view is one, what are your current set of facts, right? You're just dumping a bunch of documents on them and they're sorting through and just telling you, here's how much you owe given what you gave them. So Tom Wheelwright, I think, says it best, and I'm stealing his language. But if you want to change your tax, you got to change your facts. And having strategy before that meeting is really important. And we can get into some of the things that we do to align, a portfolio or your investments, which, I think goes into what Break a Day Capital does quite a bit. Because tax strategy aligned with your investment strategy is very powerful. Having your tax strategy separate and misaligned with your investment strategy, you're probably leaving a lot on the table. It's not just what you make, it's what you keep.
Our guests know Tom well because he's spoken at our Invest Smart Summit last year, and then a previous summit that we did, I think on asset management years ago. But yeah, let's jump into it. Dive into what you were talking about.
Yeah, as far as like tax strategy. So,
Yeah.
I think a good example, if we just look at a CPA's perspective, right, in the current year, I think the most common recommendation might be about maximizing pre-tax retirement accounts. And so it's if you're a W-2, high income earning W-2, that's an easy lever to pull that the IRS provides. You put money in, that drops your adjusted gross income immediately, proportionate to how much you put in. That grows tax deferred. At some point you pull money out, you pay ordinary income tax. The gamble there is you're assuming tax rates stay somewhat similar because in the world where taxes have to go up because let's say the government doesn't do a good job balancing the budget, or our interest carry, they might have to raise it, or if tariffs happen to be illegal or something like that. So it's definitely a concern. And so just having a mindful tact of not over allocating to pre-tax accounts where I've got a lot of clients where that's the biggest mess we're trying to help them clean up. What strategies can we do to get money out of pre-tax accounts so that we don't trip required minimum distributions in the future where they're pulling out more, paying more taxes because the government's telling them to, not because they have got a retirement income need of that amount. So that would be one piece of it. Another would be there's strategies where what I'm seeing is a lot of people are in like the S&P 500 right now for investment accounts. And instead of being in the S&P 500, if you've got a significant amount of money and high income, you could be doing a direct indexing strategy where we're harvesting losses and creating tax assets along the way so that we're incrementally raising your cost basis. So in 10 years, if you put 500 in, you're not at, 1.2 or something like that. And then there's a lot of unrealized gains. And again, if you want to change the strategy or take money out and invest somewhere else, now we've got a long or short-term capital gain situation. So we want to be mindful, and for everybody it's a little bit different, so I don't like to give broad advice. It's more
Right.
of typically I'm sitting down with somebody understanding their situation and trying to live a day in their life. So I'm like, if I were in your shoes, knowing what I know, this is what I would do differently. And typically we'll model the difference out and then look at what are the variances and outcomes.
I love it. And um, maximizing your tax strategy has rocket fueled my net worth, and that is such a powerful tool when you're focusing on that.
Hmm.
What are some of the biggest financial mistakes you see high net worth investors making today?
Well, so I'd say the number one is what we just talked about.
Yeah.
So not having thought through their investment strategy along a tax efficient frontier. Um, Another one is fad investing. I just
Okay. What's
see,
that?
yeah. So I'll get into it. So when I say fad investing, I just mean what worked in a short period of time. All of a sudden, they're like taking excessive risk into that. So I think of, through 2020 and 2021, AMC and GameStop,
Yep.
right? Investing in these companies that were doing really poorly financially, but because there was, Reddit accounts, all of a sudden money was chasing it. And, there's this sort of like, I don't know, retail investor vigilante group going against the big guys, right? So that
Right.
would be one. I've certainly seen cryptocurrency be one. I've seen gold and silver last year was one. Right now, the S&P 500 is on a pretty good decade run. So a lot of the new accounts I'm starting to see are just that, right? And there's a lot more to the world of investing than 500 companies in the US. That makes up a very small portion of the world's sort of, whole class of investment opportunities. So those would I guess encompass a few. Now, if you're really high net worth, then you need to have a special mind to your legacy and how do we transfer those assets effectively to the next generation. But I'd say for anybody sub 30 million, those top ones come to mind quite a bit.
Nice. And which brings me to my next question. You kind of alluded to it. Like, how do you determine whether a client should be investing in alternatives versus traditional stocks and bonds?
Yeah, it's a great question. So a lot of it comes down to where they are on their financial journey. But when I look at a balance sheet, just very simply, I'm typically looking across a couple different frameworks. So one would be how much liquidity do we have, right? One would be what kind of tax environment do these assets sit in? Um, and then the last would certainly be like what kind of risk are we taking across these assets? So liquidity is an important piece, and if you've got excess cash, you've got investments in a non-qualified or taxable brokerage or advisory account, we have plenty of liquidity and we can start to get some money into illiquid investments, whether that's a syndication with a group like yours or private equity fund or venture capital fund or hedge fund or, you name it, opportunity zone fund. So lots of options and strategies out there. But we're just looking to maintain some amount of liquidity to keep ourselves from ever being in a situation of being a forced seller. Because as I was mentioning before, most markets, if you look at an asset class, whether that's uh, large cap, mid cap, small cap stocks, if you look at real estate, if you look at gold and silver, it's all on a cycle, right? And so that cycle's got this pendulum swinging back and forth. Um, what we don't want to do is have that pendulum swing the opposite way on us, knowing that it's temporarily down, maybe marked down on paper. We just don't want to have to sell while it's down. We want to let that cycle continue through so that we can be in control of the timing of that decision. Because I think that's another big thing that sometimes gets missed. And with illiquid investments and not balancing those with some liquid ones can then, pose some risks for you as far as your balance sheet's concerned.
I'm curious, what's the percentage? I know everyone's a little bit different, but a range of percentage that you would want someone's portfolio to be liquid.
Yeah, I mean, ideally, I'd say 20 to 30% liquid. Where most wealth ends up being stored is typically in retirement accounts, which in a lot of ways there are some avenues to get money out of it, but it's usually a penalty or a tax consequence. So we see a lot of money in retirement accounts, and if you're your age or my age, we've got still some time until those become efficient liquid pools of capital, and we see it in the equity of homes, right? So, I think if you could keep 20 to 30% of your overall net worth liquid at all times. And then as you grow money outside of retirement, it could be in retirement, right? Like sometimes we might want some of those illiquid vehicles in the retirement account because they'll mature to being liquid within the time frame of when we need them to be liquid, right? So, like you said, it definitely depends. But we're looking at what's the makeup of the balance sheet and what levers or options could we pull. But since you brought up liquidity, I think, lines of credit is another really interesting topic. Your audience will be very familiar with uh, cash out refis, home equity lines of credit. In the investment world, you can put a security-backed line of credit on an account. And so sometimes when we've got really large positions in taxable brokerage accounts, we might just collateralize that position, use up a piece of the arm. We don't want to over leverage, but that liquidity could then be used to go into a private investment. So we still maintain liquidity under that account. We have the private investment, but more importantly, we didn't pay taxes to free up that capital because we borrowed out some of those gains versus actually selling, realizing them, paying the taxes, and then trying to make our investment. So again, it
I love
just
that.
depends on what we're trying to do, but I love to, it's one of my favorite places to start is figure out like how do we find the money so that we can daisy chain your balance sheet together to own more assets that are productive that will then spit off cash flow and support the whole thing.
Yep. Yep. I love it. And so a good segue is what role does real estate play in a well-diversified portfolio?
Well, I mean, you know probably better than most that many of America's millionaires, real estate was an avenue. I'll give you a personal story on this one, and then I'll answer your question. So, for my wife and I, real estate played a critical role in us growing our wealth. I want to say we borrowed out of our 401k in 2013, 30 grand. So I think it was only 60 grand at that time. I'd only a few years out of college. So I borrowed out the max and I sold $30,000 of my stock market portfolio at the time. So I had 60 grand, which happened to be about 10% on a $600,000 house. So I put 10% of the money up. The bank gave me 90. Well, that house at 600 in 2013, fast forward to 2026, is worth about 1.5. So I got to say that 60 grand worked very, very hard for me. And also because of all that appreciation makes real estate a outsized portion of my overall net worth, right? So I don't like to say that it's a hard and fast one or the other, right? Because you could 100% solve financial security and independence being 100% allocated to real estate. Conversely, you could be 100% allocated to the market and address the same question. So a lot of it comes down to personal preference, how you've educated yourself, where your zone of competence is. And then really it comes down to, do you want to actively do it and do the work? Or do you want to work with a good operator and leverage their expertise, right? And some of that skill set sort of spectrum might push you one direction or the other.
So given today's environment of market volatility, inflation concerns, geopolitical uncertainty, where are you guiding clients to focus on? Or certainly, again, like you said, their area of expertise, but is there things that you're kind of avoiding or things that you're doing more of?
Yeah, so I'm typically talking always like preaching long term, right? So a long term mindset. Um, when you really start to study the markets in general, they go up over time. It's just like the short term that we have to worry about. That's why the liquidity conversation was timely.
Yep.
Um, but realistically, we're in a really exciting time. If you look at the earnings growth across large corporations in America, 6 years ago, profitability would have been around like 9, 10%. That's expanded to 15% on average for earnings calls this year. So the fundamentals of like, hey, I own a small piece of a company and it's reaching more people, it's growing top line revenue, it's getting to new market shares, it's implementing AI across the board to do more work across fewer headcount. The tax environment's better since, July of last year. So all of that is very supportive. Geopolitically, certainly the war in Iran, the elevated fuel prices, the inflation threat um, could create some friction or sort of headwind for monetary policy. So that's definitely the most like relevant sort of going concern, right? Depending on where this whole thing goes. But if we're talking about a 7 to 10 year time horizon, I'm very bullish on the improvement in humanity because of some of the tools that are coming online. And really, this race to build out extra data centers, extra energy to fuel them, new markets in space, maybe on the moon. I never would bet against human ingenuity. And when you're in the market and in real estate, even, that's essentially what you're getting, right? Because as people make more money, they're going to need a place to live as there's more humans on this earth. It's a pretty, recession-proof business, right? So always long term. And then I think it's very healthy to be pretty balanced across the portfolio because, again, certain asset classes are going to always be performing while others are coming down. What we try to create is this effect where one might be coming down as one comes up. So we're always moving up and we're rounding out that volatility while we're seeking those risk adjusted returns over time.
What
But
trends?
I'm pretty excited about the next, call it 8 to 15, 16, 18 months.
What trends are you seeing among your most successful clients?
So I think this comes down to fundamentals, right? My most successful clients, they've they've on the front end decided, hey, I'm gonna save a certain amount of every dollar that hits my checking account. And so I like to explain it as, when the government in 1913 legally got the right to take taxes before you ever saw your money, future Gary should have the same rule where when the second the money hits, you've already assigned 10, 15, 20% to go somewhere else that's going to fund and fuel future Gary. I always want, for myself personally, future Bromley to want to hop in a DeLorean and give me a big hug because things are so good on the other side, right? So I think that my most successful clients, they're coachable. We do a pretty good income and expense analysis to figure out what's our capacity to save based on their goals and timelines. It's either what could we do or what do we need to do to hit the goal. And so we automate a strategy and like I said before, we'll meet about quarterly to make sure we're staying on track, right? And as new opportunities come into their kind of peripheral, we'll evaluate them. Hey, relative to your goals, does this support them or is this a distraction? And we should bat them down and move on.
Yeah, doing it on a quarterly basis and really making them focus, I think is so important. It's I see a lot of people like you mentioned earlier, chasing fads or
Hmm.
spending more time planning their next meal or their next trip
Yeah.
than really diving into, building that future, those investments and really focusing in.
100%. And I mean, it's probably based on what I do too, I tend to find that not that people aren't capable of, doing a lot of the planning on their own, especially with the tools and technologies today. It's just not an area they're interested in. And, I kind of think of myself as, if the book Who Not How, right? For a lot
Yeah.
of my clients, I am the who that helps them organize their financial lives. Because not again because of lack of skill, smarts, etc. It's just because their energy comes from doing other things. Or maybe if they double down on their career or they double down in their business, they'll move things far faster than if they became an expert on technical analysis in the stock market, right? So, um, but I'd agree. There is a set of population that loves this, right? Like we're in a GoBundance mastermind, and I'd say the big difference between that group is they're over leveraged in learning about, different investment strategies and tax strategies, and they're very, very well informed. And for good or for bad, right? Some of them make great investments, and some of them lose a lot of money doing that. So, um, there's no silver bullet in any of this.
It's just like real estate investing. I see people just jumping in and having to deal with tenants, toilets, and trash. It's another job. They're not really focused on it. Things happen at the worst moment. Invest with a team that's experienced that you trust, just like a financial advisor. You do this full time. You have a team of people, you have all these resources at your fingertips. This is what you do. Let you be the expert and help guide someone build net worth, build a legacy.
Mm-hmm. Yeah, 100%. I mean, I've often told like a new client, hey, like you need to, if it's a couple, like go out and celebrate because you're millionaires and they didn't even know it, but we just put together their, personal net worth statement for the first time or their balance sheet, right? And so they're discovering as I'm asking questions, they're like, oh, wow, we didn't even know we're that far along. So yeah. But if you can track it and manage it, you're going to have a better outcome, most assuredly. What you focus on, you tend to, put energy into and grow.
100%. I got one more question for you. If you could give one piece of advice to someone trying to become financially independent, what would it be?
I'm going to go back to what I said before. Um, it really comes down to automating a strategy. I think for most people, they're in one of two camps. They're either money hits their account and it goes to an investment as a policy, right? If it's automated, better. If you've created like a reoccurring deposit, all the better. That works. Just trying not to spend what's in your checking account and at the end of the month, hey, some of that I'll invest. That deferred investment strategy is a deferred goal, deferred, outcome strategy. You're just not going to get there for most people.
Well, awesome, Bromley. Thank you so much for coming on and sharing your expertise and financial advice. Where can listeners find out more about you and what you do?
Yeah, so a couple of resources. So you can, in the show notes, I'm giving exclusive to the Break a Day Capital listeners an opportunity to book a one-on-one consultation with me. We can make that a two-part meeting where we'll really get clear on goals, build out that balance sheet, maybe discover you're a millionaire for the first time. And then, understand income, expenses, complexity of the comp structure, whatnot. And then we'll model out relative to your goals, are you on track or not? And if you're not on track, we'll do a gap analysis and then a recommended strategy to get you tuned up. So look out for that. You could also go to my website, Bromley Palamountain .nm.com, or you can email me at bromley.palamountain@nm.com, and love to see where I could be a resource.
Awesome. And take advantage of that, listeners. It's free. Bromley is a great resource. Take advantage of it. So thanks so much, Bromley, for coming on. To our listeners, thank you so much for listening. Please head over to Stitcher, iTunes, and like, subscribe, and review this podcast, as it will help us grow our audience and reach more people. And if you'd like to learn more about what we do, head over to breakofdaycapital.com and sign up for our newsletter. We'll see you next week. Thank you so much. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.